Hi, it's Dan from UK Moneyman. Just wanted to talk to you in a bit more detail about drawdown with a lifetime mortgage or equity release plan. So equity release plans can be taken as a straightforward lump sum, or quite commonly now they're taken as a drawdown facility where you have what you need to take immediately, which with most lenders is a minimum of 10,000, and then the rest of your facility can be held in a drawdown, which is like a credit limit with the lender. You can draw on the money as and when you need it, and you don't pay any interest on it unless you draw the money. Now, a couple of things to be aware of is that the size of the drawdown facility can affect your overall interest rate. So your interest rate is likely to be higher if you have a drawdown facility of £100,000 as if you had a facility of 50,000. The other thing to think about is when you might need the money. So it's very easy to look 2 or 3 years ahead and think what expenses that you might have. You might plan to change a car, or do some work to the house, or have a holiday of a lifetime even. Those sorts of things can be quantified and you can make a reasonable plan for that. But some people take equity release out and we're looking 20 years ahead, and it's really hard to think about what might be in the future. Now, one of the things that we'll go through with you when we're discussing the plan that you need is whether it's worth limiting what you have to cover the next 2, 3, 5, 10 years, and then look at raising further finance at that point onwards, or certainly reviewing the situation and not just sticking with the same plan because that's what you've got. The market is very fluid, the products are improving all the time, so it may be that it's better to look at something different later on. Some clients don't want to do that, some are more flexible, but it depends on your individual circumstances. Now, the other thing that's really important to think about with drawdown is how much you might need to take at each drawdown amount. So some lenders restrict the amount that you take from a drawdown to a minimum of £5,000. Now, if you're on benefits, particularly means tested benefits, to take a drawdown of £5,000 not only could put you over the threshold for savings, so it affects your benefits, but if it's significantly more than you need, you're paying interest needlessly on money that's just sitting there in a bank account. Okay, so some other lenders will have a £2,000 limit, £1,000 or even £500. So if the purpose of your drawdown is to cover the expenses that your income doesn't quite cover, so if you need to replace a washing machine, a fridge, smaller expenses, then you might like to look at a lender that offers drawdowns from as little as £500. It means that we can really tailor the amount of money that you take that's the absolute minimum that you need, and it saves you interest over time, makes it more likely that you can service that interest and stop it building up. So in between the point of your first contact with us or any advisor that you're speaking to and the point where you make some decisions, it's really good to have an honest look at your finances as they stand now and what you might need the money for in the future. So whereas it's important to make sure that we make enough provision for what you might need, we don't want to make too much. And really, in a sense, although we'll talk to you about that and talk to you about the amounts that you're setting aside for different things, it's really worthwhile you having a good idea in the first place about how much you might need and when you might need to access those funds. Please talk to us about it. We can take as long as you like, and we can run the fact find and discussions over as many phone calls, video appointments, face-to-face appointments as you need.